I'm Lynette Zhang, Chief Market Analyst here at ITM Trading, a full-service physical precious metals brokerage house specializing in gold and silver and really specializing in strategies to help support individual goals. And that's really what we're going to talk mostly about today. So I've named this Blinded by Confusion. And these are the opportunities that present during hyperinflation. And I'm really referring to that nominal confusion piece. You're going to see what I mean by that overall in just a few minutes. So first we're going to take a deeper look at the typical trend patterns. And it's not so hard to see once you know what to look for. I'm going to show you why I'm saying that Germany and Venezuela actually have quite a bit in common. You'll see why. And of course, the opportunity that lies ahead as all assets go to their true value, their fundamental value. Because you see, wealth never disappears. It merely shifts location. And the goal of the strategy that's based on all of this work that you see is about having the wealth shift your way, not just away from you. So with that, let's begin with just basics. And this is overall the typical pattern of a trend. And there are essentially three major phases in there. It's not necessarily important that you know all of these nuances. I'll show you the one to really key into. But overall, in the first phase, that's called the accumulation phase. And that's where smart money have recognized an undervalued situation and begun to accumulate really quietly. At the same time, there is black bearish sentiment. Like, it's just so negative. Oh, I would never buy another stock again. I would never buy another piece of real estate again. I would never buy gold again. Now, of those three, we certainly know which gets the most negative kind of press. But that's what you want to listen for. And then when you do that, you're likely to see that we're in the first phase, which is also typically a cup formation. Then you move into the second phase, and that's really when Wall Street starts to pay attention and starts to accumulate. And then before you know it, well, first of all, the sentiment turns positive, and then the news media picks it up, so there's a lot more discussion about it. And then a lot more enthusiasm with that Wall Street rah, rah, rah. And what you have as the public is now participating is you have the insiders selling to the general public, who then are typically left holding the bag. Okay, right now, I believe we are somewhere in this return to normal part until we end up here. And then there's your despair, which is why in the first phase, that accumulation phase, that cup formation phase, is where you hear all of that black bearish sentiment. And honestly, it doesn't matter, what asset or instrument you're looking at, you're going to find that manipulation does skew this, and we'll talk about that a little bit too. But you'll find that these patterns, regardless of what you're looking at, are remarkably similar. I mean, even in age, you've got the young, the young child, and then the teen, and then you're in your, 40s and 50s and 60s, and then it goes that way too. So it really doesn't matter. You can kind of shift it, but this is the pattern. And now let's take a look at some real life examples. And remember, this is 1929 right here. And this is when this whole thing was kicking off. But in 1913, the Federal Reserve was legalized, and they had a charter of 20 years. In other words, they were going to go away in 1933 unless their charter was reinstated. Okay, so they had a 20-year charter in 1913. And you could say that that was the accumulation phase. And then in 1927, the Federal Reserve was granted a perpetual charter. Now, this was the first time in history that any central bank had been granted a perpetual charter. And personally, I do not think it's a coincidence that the era of perpetual charters coincides with the era of perpetual war. But that's another story for another day. Once they were granted that perpetual charter in 27, it wasn't until 28 that the general public began to participate in the markets. But you know, they saw them moving up, and of course, you know that we were now transitioning onto a fiat standard, so the average income had more than tripled, and they wanted to emulate the smart money. And so they started to participate in that third phase here, where you can see the peak, but the insiders were selling into the buying public. And lots of margin debt, and I mean, there's a lot of parallels between then and today, and also in between. So then, of course, we know who's left holding the bag, which is the general public, because this is how wealth is transferred. And I want you to really kind of think about this concept. If you bought this stock up here at 100 and it drops down here to 2, well, whoever got that 100 from you, that wealth transferred from you to them, particularly if you still hold it at 2. So when we talk about a wealth transfer mechanism, you know, at this euphoric stage, the stocks are overvalued. And what you're hoping for is that greater fool theory where somebody dumber is willing to pay more to push the price up. And we've seen this quite a bit in the last year even, and even in the cryptocurrencies. However, now we're going to look at the NASDAQ bubble. And so that was in 99. And here's your accumulation phase. Here's your awareness phase. We see the panic phase when the public is the one that gets involved. But I'm going to tell you, and it should be pretty obvious to see, that quite frankly, when you take a longer term view, you can see these patterns. And don't they look so similar to the original pattern that I showed you before we even started here? And I did not create that. Okay, I didn't create any of these actually. These two come from the Federal Reserve, and the other one follow the link, but a very bright professor, he might be at Tulane, but I could be butchering that. But you have the link, you can check it out. And obviously, the best time to buy is inside of that cup formation, simply because that is most likely to be, well, it is somewhere near a bottom, and so it's most likely to be your cheapest place of entry. This is not rocket science. You can see that. And remember too, I'm going to point this out, if you want any copies of the charts, though, you can go and look at them, but here's the pattern, if you just tell us this, give us this information, we'll send you this slide. So not a big deal. Just call one of the precious metals consultants, and they're happy to email that to you or mail it to you, whatever you want. But you also need to know, like I said, no matter what asset you're looking at, trends always look pretty much the same. I mean, obviously there are nuances. This is the Japanese asset bubble in the 90s. And here's their stock market. And here's their real estate market. Now, I did a bit of study in this, and I can tell you that during their price plunge, residential real estate dropped 85% in terms of, in terms of its value, in terms of the yen. Okay, but residential real estate dropped 85%, commercial real estate dropped 95%. So where do you want to buy in? Now, we do always have to have a place to live, so I'm not recommending, none of this is a recommendation. This is more for you to look at the patterns and determine, because I really feel strongly that there are 3 key things that you need to be aware of. Number 1, at some point, and I can't tell you when, well, in this case, maybe I can, but at some point, all assets and all instruments move toward their fundamental value. That's their true value, and that I'm going to talk about in next week's in part 4, because this is part 3. Okay, but I will be talking about that in part 4. You also want to know whether it's a positive or a negative trend, and then you also need to know where we are in this cycle, and that's what this is about, to help you get a handle on that and start to recognize these patterns. So clearly, when you're in that panic phase, whatever that asset is going to unrealistic and very overvalued levels, and things do not go up forever, no matter what they might want you to think, and you have your correction down. But you can see real estate and stocks, and it's a similar pattern. And here's another similar pattern. And, you know, you're going to relate all of this no matter when this took place. I'm going to show you how it relates to today as well. Because what we're looking at here is the performance of the German stock market during the Weimar Republic hyperinflation. And wow, look at this. It has gone up so high. But that's because people are trying to hold on to value. And so, you know, I mean, they didn't have any choice. They couldn't cover their butts with gold then. So they run to what they perceive as the safety of the stock market. Except you have to remember that on the stock market, the valuations are in terms of that currency. And when you convert it, it's not like you're going to the building and taking, oh, that's my brick and that's my chair. It doesn't work like that. So when you convert the stocks, you can only convert them back into fiat. In terms of dollars, so the dollar at that time was backed by gold. So the real value of the stock market at that juncture is really here, not here. And it is because of the value that's lost in the currency. So here's Venezuela, and what you're actually looking at is the black market value of the Venezuelan bolivar, not the official, the black market. And you're going to see why I said Germany and Venezuela have a lot in common, because on 2/5 of 18, the bolivar was officially devalued and then reset. We're going to talk more about that in part 4 as well. But even moving up to that, the markets had shown everybody what the true value of the bolivar was. I mean, it has more value as a napkin for an empanada than it does to buy anything. So let's look at their stock market, because, oops, did I, in an attempt, sorry, to preserve wealth, because this I just pulled on April 26th. And this is the Venezuelan stock market straight up. So it looked very much like Germany's stock market. Not a big shockerisky. And this is a quote from this article. Local businesses and individuals are piling into equities in a desperate bid to protect their savings from a plunging currency and quadruple-digit inflation. So, you know, we've been really taught that we only have choices among fiat money products. When you go to anything physical, you're called a bug, right? You're a gold bug. And you're really derided. Oh, it has no value. It doesn't pay interest. You know, you can't use it. You can't eat gold. Well, you can't eat dollars either. But they don't want you in real money, because then you're not subject to this. Now, I'm going to read this quote too. It's kind of small, so bear with me on this. But this was just pulled on April 26th, so just a week ago. Regulators say they have to lop 3 zeros off the price of equities on the exchange after determining its computers could no longer handle the swelling values for local shares, as the bolivar has tumbled more than 99% versus the dollar in the past few years. The change takes effect, today, May 2nd. Okay, so you know, you may be flying to the safety of the stock market. It's not safe, okay? It's not safe. It's within their realm and the things that they can do, right? It's not private. It's not safe. And it's not real, okay? So even when they're going up, if the value of the currency is going down, we'll talk about that in just a second. So where are we in this trend cycle? Okay, well, here's real estate, whether it's commercial, residential, or farmland. Kind of looks a little bubblicious to me, but hey, it's not a bubble. It's just expensive. Don't worry, be happy. And how about stocks? And how about rights? So what I've actually shown you here are a number of ways that you can generate income from real wealth and actual tangibles. Right now, at these lofty levels, I've been showing you for a very long time, when I do the insider trading piece, I show you how heavily the insiders, the smart money, those in the know, are getting out. Apple announced the biggest buyback, I believe, in history today from the repatriated cash. Well, what are the insiders doing? We'll take a look at that tomorrow. But I really want you to take a look at these income producing assets at these lofty levels, especially the stock market, because that's what most people look at, right? As long as the stock market is going up, it's certainly everything must be okay. But frankly, what goes up must come down. They're still, even in this correction that they're in right now, this breakdown that they're in right now, they're still in very lofty levels because this is not a real market. Just like Venezuela is not a real market and Germany's wasn't a real market when they were going into hyperinflation. Smart money knows this. That's why they're selling into the public who doesn't know this. And instead, they know this trend. This is the real trend. And that's in the value of the currency. And we happen to be looking at dollars because I can get that most current. But every single fiat currency looks like this. This is that trend pattern. Because that is the design of the currency. This is due to inflation, and guess what? We found out that the Federal Reserve has hit that 2% inflation target. Well, what this shows you, especially, we can see that trend, but look at this, because this is the same graph, but it starts in 2008, and it's current. These go to March. The most current update was March of 2018. There's 4 cents left. I mean, this looks like it's flattening out, but here's what's really happening in it. It's just happening in smaller incremental levels because they've already taken over 96% of the value out of the dollar officially until they do it overnight. We're going to look at that next week. But be clear that this is the real trend. The value of the fiat currencies. And this is why the system has to reset. Because the next step is to attack your principal. But I don't want to go there in this because I want to just talk about the opportunities. You can see that this is happening. This is what the insiders, well, not all the insiders, but the central bankers certainly know this. They all know this. And probably a lot of the 1%ers really understand this too. That's that nominal confusion piece. If the stock markets go up, then, hey, everything must be okay. But $1 trillion times 0, it's still 0. So you can be a gazillionaire in Zimbabwe or Venezuela and you can starve. But now let's look at how spot gold has actually reacted to the loss of this purchasing power. Now, I got to be honest with you guys. When I wanted to do everything from when we went fully onto the, or at least in these graphs, when we went fully onto a debt-based system. So I really wanted them to be somewhere around 71. And look, lo and behold, when we look at the long-term graph, we see a cup formation that happened right as kickoff was beginning. And remember, I always show you resistance, right? So that's the height before. Once it hit that same level and broke above it, then what did it do? It zoomed up. That is a typical standard pattern. So here's your accumulation phase, here's your awareness phase, and here's where the public participated in the panic phase. Okay, but guess what? As soon as that in gold, as soon as that phase was at its peak, that's what it had to break above. The fiat price had to break above that, right? So look at this big, huge cup formation as they were suppressing the price of gold, because a rising gold price is an indication of a failing currency. They don't want you to know what I just showed you, even though I get that from them and you have access to it. We all have access to it. It's just nobody goes in and looks. So once that broke out, okay, we were off to the races again. This was, by the way, was 2004 when we broke out. Okay, so we had that huge correction there, and look at that steep run up. Can you see this pattern? But every time they do it, the pattern gets bigger and bigger and bigger. This was about 1900 right here. Look at this cup formation that's forming again. I feel very confident that right here is the bottom, and that would be mid-2016. That's the bottom. We're forming a cup. And I can tell you this is not just a typical cup, because this has everything to do with this, the value of the dollar. And remember, the way that they control the rate and speed of inflation is via interest rates, because this is a debt system. And we've been now told that by the end of 2021, so December 31st, 2021, by that date, the interest rate that is used most in any kind of contracts and any kind of derivative contracts, everything must be reset by that date. This is the end, my friends. Can you see this? That's why you have to get to safety. And that's why, even though this is manipulated, and we know it's manipulated, easily so, that is why you're still getting a cup formation in here, because smart money knows what I am showing you. They know those formations. If you don't know any other formation, just keep this in mind. Black bearish sentiment. I would never buy another ounce of gold again. It's the worst thing I ever did. Thank you, because then you test the fundamental value. I can tell you easily and without any level of hesitation that conservatively, 1 ounce of physical gold for its fundamental value, the most important function that it was created to perform, and one that it's performed for 6,000 years, to hold your wealth and your purchasing power intact. That's the most important function of gold. The current value in terms of dollars is at a minimum level somewhere north of $9,000. And this isn't a number that's arbitrary, because I think it's pretty obvious that I am not an arbitrary gal. This is all based on how they usually do the reset. They have to revalue all of this garbage that's out there, all of this fiat money, against finite gold money. And just like we saw in Venezuela, we're going to talk about this in part 4. I'm going to show you this, how to determine fundamental value. We're going to go over all of that next week. But what you really need to be aware of is this cup formation. Because if you can, I'm just going to scooch to the end here. If you can get this okay, then this noise that's in between with all the manipulations, you don't hear that. You're just looking for the pattern. But a key is gold is awful. Don't buy it. Right when central banks and the 1%ers and the smart money is accumulating it as quickly as they can. But guess what? They're also doing it as cheaply as they can. Interesting. But now you know too. And so we want to just make sure this all goes into the strategy and it all determines what you need. I mean, we really fine tune this, and we're there for you through the whole thing. This isn't just throwing you in a random piece of gold and trusting that you're going to really be able to recognize all of these things. I mean, you know we are keen on education. I'm going to keep doing these videos so that you can learn how to, so to speak, fish for yourself. But, you can lean on us if you need to. I mean, that's what we're here for. So I have a very exciting couple of weeks coming up. So I want to tell you a little bit about them. Oh, before we do though, and we've been talking about Venezuela, let's see, the gold to Venezuelan bolivars is now up 3,680,509%. It's up quite a bit. We'll look at that more next week. And silver is up 2,928,896%. Pretty amazing, pretty amazing. But actually, it's gold going to its fundamental value. And so when those assets goes down, gold goes up, then you convert some of the gold into those other assets severely undervalued. It's how you buy low and sell high. I am not a short-term trader. I don't care if I miss things. I just always want to be properly positioned, because my personal preference is to have the lion's share of my wealth in an undervalued asset that's in a long-term positive trend, and the least amount of my wealth in an overvalued instrument that's in a long-term negative trend. Not rocket science, pretty simple, really. So let's see. First, I would really like to thank Gary for this beautiful horse brochure. That was so sweet of you to send that to me. So thank you very, very much. And then also, SGT should air tonight. I really enjoyed it. We really talked a lot about the LIBOR and what was happening with that. And so I encourage you to go and watch it. I think it'll be really good. I may actually listen to it. I don't know. I don't usually do that, but I could. At any rate, next week I have Rethinking the Dollar on Tuesday. It's recorded. And then on Thursday, Mega Book 2 for me next week, A Minute to Midnight. So that'll be on Thursday, and that too will be recorded. So, she'll let you know when those air. And then, of course, in just, 2 weeks? 2.5 weeks? We'll be traveling to New York for the live event, and it's On the Road with Lynette, and I definitely will be talking about the 3 key issues. And I decided what they're going to be are the ones that give me goosebumps. That's what we're going to be talking about. So bring your questions, and we're going to have lots of times for that, and I hope I see you there. I know there's a lot of people that are coming, and I'm really excited to meet you, face to face. That's going to be wonderful. And then on Monday with Gerald Salente, I'm very excited for that too. It's nice to go back to my hometown and to see. I love the fact that he lives there, because every time I listen to him, it just kind of takes me home. So, and he's a very bright man, so it's always a pleasure to interview him, and I'll be doing that on the 21st. So, anything else, Megan, that I'm forgetting? Nope? Okay. Then that's it. Please be safe out there. If you like this, give us a thumbs up. Make sure, these are really the ones to share. I mean, we're at a point here where, this is a technical one, so that's up to you, I suppose. But this is a really key tool. In my opinion, this is a key tool, and it's not rocket science. So share it. And in the meantime, till I see you hopefully tomorrow, then please be safe out there. Bye-bye.